Señoras y señores, hoy contamos con un episodio muy especial de Orion Room.
We're going to talk about trading. We're going to get into specifics about your trading strategy, your journey. You have a very unique story, but I want to get into those early days, even before trading, where all this success came from.
My parents always pushed me to excellence. So from a young age, we didn't do vacations. We didn't do fancy things. All the extra money went to education. And I hated it at the beginning because I see my friends playing, I see my friends going on vacation, and I'm studying extra. And that pushed me into a very conformist way. The path in front of me was do well in school, do well in high school, do well in university, get a good career, get a good job, and that's success. So I was very in the matrix, if you want to call it. In fact, I did what the matrix is telling us to do to its entirety.
Terminó su carrera de odontología y no ejerció ni un día como dentista.
I always knew I didn't want to be ordinary. If you want to have an abnormal life, you have to do abnormal things. So I knew that university is 5 or 6 years, and if I only achieve my degree, I failed.
Cambió su vida radicalmente y ahora es trader multimillonario en Dubái.
The moment you have 20,000 euros in your bank account, you don't need a job anymore. You can live cheap, you can afford cheap rent. 20,000 euros, you can pay for some good education, which we can talk about how to find a good mentor. You can go through evaluation prop firms, and you have a budget of 5,000 euros, which is more than enough. And you have time on your side. You're not desperate to make withdrawals from your prop firms to pay your rent. You shouldn't be in that desperate situation.
Sus decisiones se basan estrictamente en sus datos.
The sample size for any decision, minimum 100 trades. Whether that's 100 trades over 6 weeks or over 6 months or 6 years, you got to do 100 trades, because whenever someone takes a trade, a professional trader, they know that there's always reasons to go against them. A new trader will think a loss is not a loss if you learn a lesson. Very common thing we hear. But a loss for a professional trader is not like that. A loss for a professional trader is I had these reasons for my trade. I was aware of these reasons against my trade. I made the decision to still take the trade as a calculated risk, as a data-driven approach, despite the reasons against. And I know over 100 trades, 70% of the time I will be correct, but 30% or 20% of the time I will be wrong.
Con 58 trades, ha ganado un 60% de rentabilidad en los últimos 6 meses de forma totalmente pública.
I've been on my Twitter giving all of my trades ahead of time. The exact entry, the exact stop loss, and I'm giving it before with my lower time frame confirmation, and then my break-even protocol, and then my take-profit protocol. So I've been doing this for 6 months. And on Twitter, if you edit a tweet, it says edited. Some of my tweets are getting 100,000 views. So when you're getting that many views, one person should be able to say, hey, Waqar faked it, Waqar manipulated it, Waqar deleted a tweet. No one's been able to call anything wrong.
Fundó uno de los podcasts de trading más grandes del mundo.
Where if I was to measure every single retracement for the last 6 months, some of them are 5% retracement, some of them are 90% retracement, majority are around 50% retracement. Fibonacci. So I can teach people, hey, look at this liquidity, look at what this run of liquidity is, look at this time of day, and you can teach someone this, but they will never make profit because now it's how you combine them. The biggest common mistake I see traders make is...
Hoy en Orion Room contamos con Waqar Asim. Muy buenas a todos, bienvenidos a este nuevo Orion Room. Hoy estamos en Dubái en una ocasión muy especial, ya que contamos con un invitado que tenía muchas ganas de traer, un invitado que tiene mucha experiencia en el sector del trading y que hoy tenemos la suerte de poder contar con él. Haremos la entrevista en inglés, pero el equipo se encargará de traducirlo todo para que todo el valor que compartamos lo podáis entender a la perfección. So, hoy tenemos aquí a Waqar. Mr. Waqar, welcome to the show.
Thank you, bro.
How's everything?
Brilliant, man. We've known of each other for many years, but only recently finally connected being in Dubai for, well, I think 2 years for you as well, right?
Yeah, it's going to be 3 now. But
yeah, we've been in the same city for the same amount of time doing the same thing, but finally a collab. I also met your partners a few years back in Madrid, but good to meet yourself too, and we make some magic today.
Great, I'm so happy to have you. It's an honor, so thank you for taking the time.
Thank you.
And we're gonna share a lot of value. And I'm really interested in your story. Let's start by, behind every successful person, there's a really interesting story. We're gonna talk about trading. We're gonna get into specifics about your trading strategy, your journey. You have changed careers also. You have a very unique story. But I want to get into those early days, even before trading, your upbringing. How was that Waqar kid dreams? Where all this success came from?
Yeah, so childhood is important for everyone's development, and what we are as adults, as men, is usually a reflection of how we were as children, and we hold a lot of our perceptions of the world from our childhood. So our relationship to money, our relationship to success. If you had a parent who was very reserved, my parents being immigrant parents, coming from Pakistan to the UK, we had a certain frame in our life that other people maybe didn't. So that's an anchor. So my situation was my parents and grandparents and so forth, they came from a very lower class poor family in Pakistan, village and poverty. So then my father's generation, a big family, I think my dad has 8 brothers and 2 sisters, and majority of them took the route of education and became very successful. So my father's a doctor. A lot of my father's brothers and sisters are doctors, accountants, high-level bankers. So that generation was the one that left in terms of poverty, and the escape was through education. A lot of them went on to leave, go to the US, go to Australia. My family went to the UK. And that was my advantage in life, because I know that if my parents didn't make that sacrifice, I'd be in Pakistan as a villager. So for me, as a young age, the solution was education. That's what my parents saw as the path to success, to get them out of the poverty. And therefore, for me, what they encouraged was education is everything. And I think with good intention, and also makes a lot of sense. And I think with an immigrant mindset, we are not very risky. We are not entrepreneurial. We are very secure, stable salary and respected career. And my parents always pushed me to excellence. So from a young age, we didn't do vacations. We didn't do fancy things. My dad didn't spend on fancy things. It was always all the extra money went to education. So I had extra tuition. I had extra everything for education. And I hated it at the beginning because I see my friends playing. I see my friends going on vacation and I'm studying extra. And now looking back, I'm very grateful for that. But as a kid, you just want to have fun. But that was the frame I had. And that pushed me into a very conformist way. I knew that the way I was pushed, the path in front of me was this road that we have, which is do well in school, do well in high school, do well in university, get a good career, get a good job, and that's success. And to some extent it is. You have a respected career, you have stability in life, and this is a good foundation. But I knew there was more to life. And for me, I was also the responsibility of an older sibling. So it was difficult for me because at 18 years old, when you're choosing your career for life, it's very hard to know what you want to do. I don't have a passion, I'm 18. I don't know what's going to work and not work, I'm 18. So for me, what's going to work is I have good grades, I worked hard, so I became dentistry. So I chose a very high career path, ended up in Spain. So I have a lot of love for Spain, 6 years living there doing my degree in dentistry. And in that time, I realized I always knew I didn't want to be ordinary. And the statement, if you want to have an abnormal life, you have to do abnormal things. If you want to have a non-ordinary life, you have to do non-ordinary things. So I knew that university is 5 or 6 years. And if I only achieve my degree, I failed. 6 years is so much time and you can do so many things. So in those 6 years, I tried everything. You look to Instagram, you look to YouTube and you think, okay, well, I can do e-commerce, drop shipping, Amazon, all of the online guru things. And I tried them all. I have a little bit experience in everything. And my natural temperament, my style, I had a curiosity for trading. And as you know, when you take some losses, you're like, okay, if I lost, how can I win?
Espero que el episodio de hoy te esté gustando. Aprovecho esta pequeña pausa para anunciarte que nuestras cuentas de fondeo ya están disponibles y que con el código Orion Room tendrás un 10% de descuento. Tienes el link en la descripción del vídeo.
For me, it became like a puzzle. I have to solve this, and time flies and you get hooked into it. And yeah, fast forward now 8 years. I've been trading, and now since I graduated my degree, moving to Dubai, 3 years full-time now as a trader, 8 years experience, and yeah, I've come a long way. But for me, the pillars were always hard work and the typical things you hear online. But I don't have the rags to riches story that I had divorced parents and they were homeless and this and that, and now I made it. I don't have that story. I have a very middle-class, hard-working family. I was hardworking. Education was the root. So I was very in the matrix, if you want to call it. In fact, I did what the matrix is telling us to do to its entirety. Get a good degree, get a good job, I did everything there. But I realized it's not life, and what we are all achieving, or what we all want to achieve in our career, is freedom. And we always think, okay, freedom means I have a good job, because then I have a good salary, I have savings, I can buy a house, and I can get a mortgage, and then you're locked in. That's a prison. And I knew for me, dentistry in Spain is not so well paid, but in the UK, 10 to 15,000 euros a month is very achievable. I knew that would be like a golden prison. I'd have a good salary, I'd have a good life, but I'd still be in a prison. So I knew for me, freedoms that I wanted were financial freedom, time freedom, geographical freedom. Those were the three main ones. And then there's a lot of things you can add, family, relationships, spirituality, health. There's a lot of things that come from it. But I knew that if I solved these first three freedoms, everything else would come into place. Or if I solve these things, if I solve financial, then I can focus on fulfillment and passion and these other things. But finances come first. So that was my primary objective. And I knew that a job and a high-paying job wouldn't be enough. So I knew, and it also wouldn't give me the geographical freedom, and it wouldn't give me time freedom. It would be time for money. So when I started to study money and how to ascend, I realized there's stages. And also on the internet, people say you have to jump to the final stage because that's the fancy one, that's the Instagram Lamborghini one. But it's a journey, and we all have to start at the beginning and go through each step. So you start off in the realm of time for money. We will exchange our time for income, because to the marketplace we are not valuable, so we do not have leverage. So you start in a job, you start whatever that can be. So for me, I knew it could be as a dentist, and I'd have good time for money. But everyone starts off with time for money. And the objective there should not be time for money for the rest of the life. It should be time for money for a certain goal to go to the next level. So for me, time for money became, and what I recommend is, I think trading is a great vehicle. I think it's one of the most powerful vehicles in life, but I don't think it's a beginner vehicle. I don't think it's stage one. I think it's a stage two. Because if you want to make 50,000 euros in your bank account, trading is not the easiest. I think there are easier ways. For example, if you have a degree like me, it would be easier for me to be a dentist, work for 2 years, put 50,000 euros in my pocket, than trading. That was my situation. But for other people, they don't have the degree. So I'd say, okay, if you do something like sales, high ticket closing, you know that if you are 80% of the way of a professional, or 50% of the way there, you can still make money, because you will eventually come across a client who wants to pay and you don't have to say anything. You will get your commission. So there's almost a guarantee of income. But as we know in trading, people try for years and years and make nothing. So there's no guarantee. So I'd say if you want to make some money, time for money, high ticket closing, high paid income, high salary, these things are easy or easier than trading. But the moment you have 20,000 euros in your bank account, you don't need a job anymore. I think you can live cheap, you can afford cheap rent, you have time on your side now to pay for your life. And with 20,000 euros, you can pay for some good education, which we can talk about how to find a good mentor. You can go through evaluation prop firms, and you have a budget of 5,000 euros, which is more than enough to fail some, to practice, and eventually scale your capital. And you have time on your side. You're not desperate to make withdrawals from your prop firms to pay your rent. You shouldn't be in that desperate situation. So that's when you enter stage two. And stage two is with leverage. And I think trading is the best one for stage two. To get from 20,000 euros to maybe even 1 million euros, trading is the best vehicle. And that can be a long window in your life. The key here is leverage. So we went from time for money, which is just transactional, to leverage now, which is as my inputs can stay the same, my outputs will grow. So if I take a trade and I make 10% in this month, on a 50,000 euro account, it will be X. If I have a 5 million account or many accounts, it will be a lot more. And leverage is the only way I've seen people go from normal to extremely high net worth is leverage. And leverage can be many forms, and trading brings one of the best forms of leverage. Beyond that, it is the other things that I'm doing, a personal brand. If I make a podcast today, you make a podcast today, it gets 500 views. In 1 year, maybe 5 million views. So same input, greater output. And I think that's vehicle 2, is with leverage. Vehicle 3 is now you want to go from 1 million to 10 million. Okay, that's a big number now. It's a big goal. Trading now once again becomes difficult. Unless you can get 10, 15, 20 million dollars in capital, it's very hard to get a $10 million net worth with trading. And there's also bottlenecks that come in the way with large capital. Now you have investors maybe. Now you have regulations. You have execution issues. It might not be CFD. So when you scale to $100 million and beyond, or $10 million and beyond, trading becomes now not the best vehicle. Now it becomes other vehicles. And I think for that it is cash flow business, where you can leverage other people's time. You can hire a team. And we can speak about that if you want. And then if you want to get to $100 million and above, then it's no longer cash flow business, because there's a limited amount of fulfillment. There's a limited amount of customers you can have unless you have a mega business. But it's easier to build a SaaS. You have a SaaS model, and instead of optimizing for cash flow, you optimize for cash exits. And that's a different way of scaling a business. But that's a lot more complicated. That's a lot more team, investment, experience. That's the journey that I think is my path. If I see myself going from a normal guy as a student to now pursuing $100 million, that's kind of the route I want to take, and I'm along that journey, let's say.
Absolutely, that's great. And I think the key to this is the exponential growth. You don't have to be thinking about the short-term results, but what you're building in order to get long-term lasting results. That's when you really jump a career. But I wanted to take a moment, because would you just summarize more than 6 years in just a few minutes of explaining? But I know that there was a lot of doubts in your career, a lot of problems, a lot of things that you had to go through in order to take that huge jump to have a established career and then jump into the scary world of trading. Was it a person, a mentor that guided you, or was just you by yourself, self-made, made the step?
So a mentor is important, but people confuse the purpose of a mentor, and they use a mentor as an escape. It's like, okay, if I've paid someone 500 euros, that guy is now going to solve my whole life. And then they put the whole thing on them. That's not what a mentor is. A mentor is a specific purpose. And we as a student need to be aware, what are we looking to achieve with each mentor? And it's very easy to say, this is not working, it's my mentor's fault. Okay, now you're going to blame the rest of your life on a mentor. Yeah. No, we have to have a sensible approach. So for me, I was using mentors. I was using online. Trading is not a thing where you can't be like Messi. You don't have a natural talent for trading, and it's not just about Ronaldo hard work. It's you got to have hard work, you got to have talent, and you got to have good information. A mentor. There's a lot more complexity to it, because it's not a natural gift, and trading is not an IQ thing. It's you learn the skill and then you execute the skill. So for that, you need someone to show you. So you can do it yourself, and that can take years and years. And you gain wisdom, you gain experience, you gain confidence, but you also gain trauma, scars, and you waste a lot of time. So a mentor is to give you the wisdom, experience, and knowledge without the trauma and scars, and without wasting years. That's the purpose of a mentor. So you go to a mentor, say, I want to learn this specific thing from you, and I'll pay you to do it. So again, I was a student, so I didn't have the money to pay for these expensive mentorships and courses. So like a lot of people, you go deep into Telegram, you go deep into whatever you can find on YouTube, and you learn. And I was like a sponge. And my advantage was I was very academic from my school and university. So for me to absorb information I was used to it. So I became curious, I became passionate, I became a sponge. And you mix in that curiosity with a bit of hard work. But I'm not going to say I'm like the most hardworking person. It was okay, I committed myself, but anyone can do that. But it was also good information and time. I think time is the most important thing for a trader. And traders always think, I think a lot of people give up trading not because they run out of money, it's because they run out of hope. They burn themselves in year 1 and year 2 because they fall for the scams, they fall for the signal services, they fall for bad mentors. And they look back at 2 years and they think, I didn't learn anything, I don't have any hope left, I'm going to give up. And there's this cycle that I learned about at a young age, which is when you come into a new industry, and I was jumping from industry, drop shipping, sales, and then eventually trading, and you come in with optimism, and you come in with thinking it's going to be easy. So that process is called uninformed optimism. So uninformed optimism is this: I see the rich people online, they're young, they make it look easy, I can do the same. So you come in with passion, energy, excitement, and then you very quickly realize, this is hard, this takes a lot of time and effort. So you go from uninformed optimism to informed, you now know, but now you become pessimistic. You're like, okay, it's not as easy, it's difficult, it's going to take a lot of time, it's hard work, it's not a get-rich-quick scheme. So when you're at this level, this is where you take two paths. And this is where people make it, like maybe yourself and I, and other people give up, and you enter the valley of despair. So the valley of despair was, this is really hard, I'm wasting money, I'm wasting time, and I have no results. So in this valley of despair, a lot of things happen, which happened to me, which is, I have friends in my class who are all doing dentistry. And they all come from good families because it was a private university, but my family is not so wealthy. So they're going to Amazonico on the weekend, they're going to restaurants, they're having fun. I can't afford that bill, so I'm staying at home and studying. So very quickly you become alienated to your friends. Your friends are thinking, you're trying to be a trader now. Who are you trying to be? But you have no success. My parents are saying, okay, Waqar, why are you focusing on this? Focus on your degree. So when you're in this chapter where you have no results, but you're putting in sacrifice, and then people around you are doubting you, maybe you're online and then people online are doubting you, this valley of despair is very, very common because you lose your friends, you have no results, and you're also maybe losing hope, and then you fall with a couple of scams, a couple of bad mentors, you lose a couple of platform accounts. This valley of despair is the hole that people give up on. If you can, and then what do people do? They think, okay, trading is not for me. Let me try this. Next shiny object. Okay, let me try this new one that I'm seeing. Crypto, time for meme coins. And you jump. And then you realize same thing again. Uninformed optimism. This is easy. Meme coins is easy. You lose a bit of money in meme coins. This is harder. Valley of despair. Jump. And that's the cycle. Everybody reaches the valley of despair, including myself. And it's what you do in those moments that differentiates. So I always say is you've got to do things, habits in place that stop you from exhausting. And I call it the exhaustion curve. I don't know if it's a real thing, but the way I like to think of it is as time goes on, we get more and more trauma, more and more difficulties, and more likely to give up. And traders don't give up because of money. They give up because of hope. So if you have a habit of going for bad mentors, if you have a habit of falling for get-rich-quick schemes, if you have a habit for buying the bots and buying the signals and the shortcuts, you're going to give up after 3 years. But if you're the guy that's focused on education, focused on the process, not the outcome, you've set up your life that you don't need to make money today. You can pay for your rent. You've got a job. You've got stability. You are more likely to continue. And I've rarely seen a trader who's been doing it for 5 years and made no progress or no money. But it's very common for year 2, they've made no progress and no money. So the real difference is in year 3 to year 5. If you can stay in the game long enough and have good habits, I boil it down to 3 things actually: skills, traits, and beliefs. If you can have good skills, and that's a job of a mentor, that's a job of good education. Traits, meaning can you be consistent, can you be dedicated, these things we hear. And beliefs is a big one. If you lose hope, you will give up. If you have limiting beliefs in your own mind, from your childhood traumas, from your perception of risk, from your perception of the industry, if you think nobody makes more than 5,000 euros in trading, then you're going to give up. You're going to have a limiting belief. But if you know your friends have done it, you have people you trust that you know have done it, and you see they've made $1 million, well, then you're going to be open to it and you're going to work to it. So skills, traits, and beliefs, and time. If you can have these 3 or 4 things in place and not give up along the way, I think you're in a very strong situation. And for me, it's my family. My parents gave me 6 years of a bubble because I was a student. So my rent is paid for, my tuition is paid for, everything is covered. I just need to pass my exams and focus on what I want to focus on. So that window of time for me was the window where I had the luxury of, I didn't have to pay for rent, I didn't have to stress about anything. I could just learn. And that for me was my advantage. But that's not a unique thing. Not everyone has a family that can support them, but you can all work towards having 10,000 euros in the bank, and that can be your cushion to learn and have your window. So in those 6 years, I had time, and I focused on my skills, traits, and beliefs. And then you give yourself the correct amount of time, and things play out. And people say 90% of traders lose, and that's a statistic. And that's a statistic that makes people give up. I think, it's so hard. Which is true, it's 90% of people lose, but it's not an accurate representation, because I can also say 90% of basketball players never make it to the NBA. 90% of students who want to be a dentist never make it to being a dentist. Anything in life that is worthwhile, you never make it, or 90% of people never make it. How many people are in high school right now that want to be in the NBA and play basketball? I think every high school kid wants to be in the NBA, but there's only a few people in the NBA. So in any industry, 90% of people don't make it. The only difference in trading is the barrier to entry is so low. For university to be a dentist, you have to go through exams and enter the university. For the NBA, you have to be drafted. For trading, you buy a prop firm account. The barrier to entry is in the floor, so you can qualify yourself as a trader in your first week. You watch Baby Pips, you buy a prop firm account, and you think you're a trader. Well, then 90% of those traders will lose, of course. But if you are now 5 years in, taking it seriously, and skills, traits, and beliefs, I think 50% of those will make it, but you got to make it at the time. So it's not as hard as you think. You just need the correct approach. And for me, my life setup helped a lot, and that's why I always count my blessings, my family, my life setup. These are things that made my journey a lot easier.
Yeah, this is very, very important for the people to understand that this 90% is not, as you said, an accurate statistic, because in these statistics also enter the guy that deposit 500 euro and blowing it up in the same day. In this statistic, enter the gambler, enters your cousin's boyfriend, whatever that heard into getting into this Forex thing, and he blew his extra payment that he got from his job. So all the beginners are very scared because, again, it is a true statistic. 90% of the people lose, but it's not 90% of the people of the serious trader that go through certain professional steps because if you really count all these traders that go through a good path, following a mentor or education, self-learning, and take things seriously, you said 50%, I would say even more of them, they can make it. Over the past few years in my career, I've encountered a lot of people that were professionals, C-level executives, or just regular jobs as firefighters, police officers, that they wanted to make a career in trading, but they are stuck in the same race that you were in. And somehow the more time they pass, the worse for them, because they probably gonna get a family or they get a new mortgage. So every year that it passes, it's harder for them to get out of this rat race, let's call it. What was the key for you to really step out? Because it is a big jump. And what would be the advice that you could tell to all these professionals, firefighters? Because I know a lot of them, they are watching this show right now, that they are doing trading as a side job. What will be the main factors and the keys in order for them to convert this side hustle into a full-time trading job?
To be honest, it's not easy. It's not easy. And I always fall back on, if it's hard, it means it's worth it. But the reality is it's not easy. And I'm not someone to say, like, if somebody has 2 jobs and 3 kids and a mortgage, it's going to be hard. And I can't say, do this and it'll be easy. My situation was easier than that situation. And therefore I count my blessings. But if you do things at a young age, you have an advantage, because worst case scenario, you go back to your parents' house. If you're doing it as a student, worst case scenario, well, there isn't one. You still have your degree at the end if you pass your exam. So if you do things at a young age, it's always going to be easier. And as you said, as you go later in life, kids, you don't have also the same time to fall back and start again. So doing things at a young age. But let's say somebody is older and you have a mortgage, you have kids and a job. Now it's also hard because you don't maybe have the time to be on your laptop and trading, because you're depending on the job. If you're working construction, no chance. But if you're working in an office, okay, 2 tabs, you can make it work. It really depends on the situation. But if I speak as a summary, there are a few things we can do. But for some person, it might take 1 year. Another person maybe takes 3 years. So that's depending on the individual situation. But what we can agree on right now is the best time to be a trader, because we have the most information online. We have the access to great people, great content, and prop firms. So now you can have good education and you can have no real risk. Your maximum risk is going to be a few $100s to pay for these evaluations. That's not what it was like 8 years ago for me. So this situation is birthed for an amazing opportunity. But as we know, amazing opportunities brings more scammers, and it also brings more get-rich-quick mindsets. And there's a double-edged sword. So there is also an element of realism. But what I can say is the journey to a successful trader, people think it's down to information. And there is an element of information that is needed, but it's not the be all and end all. So what people do is, I need courses and courses and courses, because this course didn't give me enough information, so this one will, and then this one will, and then this one will. And then you do 20 courses and you realize, okay, 19 of the 20 said the same thing. Trend line, Fibonacci, it's the regurgitation.
Yeah.
And what you realize is, whether you do 10 courses or 50 courses, you will not be profitable no matter how much information you have, because the key to a profitable trader is not information. It's application, it's market experience, it's market IQ. And what people usually do is they do a lot of courses, they have a lot of information, and they become like a textbook. I know all of the concepts. I know Elliott Wave, ICT, indicators, they know everything, but they don't make any money. And what they do then is like, it's my psychology. It must be my psychology. And now they go down that rabbit hole. They work on everything, which is great, but these are all escaping the real situation. Psychology is important. Trading technical information is important. But what I think it's stages. First, you have to build your technicals. You have to have information. If you don't have information, the best psychology in the world is not going to help. Information comes first. Once you solve information, concepts, theory, then it becomes application. You need to now have data. This is where a trader is made. I'll speak on this. And then the last one is psychology. Because as a trader, if you boil it down, it's very simple. You need to have a profitable edge, a proven profitable edge, and then you need to follow your profitable edge. Finding the edge, strategy curation, is information and application. And then psychology is basically, can I stick to the plan? So it's three simple things, but people do it in the wrong order, or they focus too much on one. But if you do it in the sequence of edge, proven edge, once you have the proven edge, then it is or strategy curation, then it's application. Once you have the application, performance, then it's psychology. If you focus on these three in that way, we can speak about each one. So the curation phase, I, like you, probably have done a lot of courses, a lot of information, and probably the same as you, we're both textbooks. If you ask me about Fibonacci, I can speak. If you ask me about Elliott Wave, I can speak. If you ask me about Smart money concepts I can speak, but it's not about any one of these. And what I realized is it's how you combine them together. And there's no one school of thought that is the miracle. And I can't say like, oh, the best one is this or the best one is that. But what I can say is what is better. And what I think is better is looking at the market from causation, not correlation. And that's the mistake people make. They go for correlation. Now, correlation is basically as one thing happens, another thing happens, but they don't affect.
Yeah.
For example, the analogy I like to give, it was a random one I thought of. If we go to the beach now in Spain, I think a lot of people are going to be having ice cream compared to the winter because good weather, families are out, kids are out. So ice cream sales go up. As the good weather comes, the ice cream sales go up. But at the same time, more people are on the beach, more people are jet skiing, more people are doing water sports. So water sport injuries probably increase in the good weather. But does increasing in ice cream sales cause increasing in water sport accidents? No, there's no causation. It's just two correlations. And a lot of trading strategies are correlations. A Fibonacci is a correlation. It's a statistic, it's a bell curve where you have your normal distribution, where if I was to measure every single retracement for the last 6 months, some of these impulse retracements are going to be 50%, some of them are going to be 90%, some of them 5%. If I document them all, it's going to be, okay, some of them are 5% retracement, some of them are 90% retracement, majority are around 50% retracement. Fibonacci. So Fibonacci, the market is not reversing because of the Fibonacci. The Fibonacci shows a reversal zone that is more probable. Okay, it's a statistical edge. It's a correlation. Same for a trend line. Same for a support and resistance. Historically, this level is supported. Therefore, I think it should support again. It's a probability. And it's an exercise I like to do with a new trader. I say, open up TradingView, go on any time frame you want, and close your eyes and leave a line. Just drop a horizontal line. And you will go back and see it's going to touch magically exactly at the line you put. Correlation. It's a randomness thing. So if you're looking at the market from strategies that are correlated, which there are majority, trend line, Fibonacci, EMAs are lagging, all of these things are correlation. If we now move our focus to causation, that's when I see real changes are made. What are causing the market to move? There are a few, but they are very specific, and we can agree on them because there's no debate on it. When the market is more volatile, more meaningful moves happen. So if I want to trade a euro dollar, there's going to be more meaningful moves in my London session than in my Asia session. So time of day is important. So if we can find the time of the day where there is most volatility and most manipulations, that's when we can find the most meaningful moves. We can find moves in Asia, but it's unlikely you're going to have a new higher high on the M15 or the H1, the 1 hour time frame during Asia versus during London. It's going to be happening in London. So time of day is important. Liquidity is the essence of the market, I believe. What causes price to go from A to B? Okay, supply and demand, yes. But how do you get more supply, or how do you get more demand? How do you get more people in the market? It's through liquidations. The market knows where there is orders pending, and they know where there is stop loss positions, and they'll go from these zones to zones. And if you start to look out how important liquidity is, I think it's the oxygen of the market, it's the essence. If you're trading without liquidity, I think you're trading blind. So what I add in is market structure is important. Supply and demand is important. Liquidity is the most important. Time of day is important, and that's where I build a daily cycle. And a daily cycle comes in where price doesn't go from A to B directly. It goes in roadmaps. So certain days will go directly. Other days will go higher, lower, higher. Other days will go higher, lower, higher, all the way down, and then high. We can draw infinite amounts of roadmaps. So when we start to plot these roadmaps, you'll start to realize there are certain ones that are common and repeating. And these common repeating ones are daily cycles. So daily cycles is the way the day moves. That can be a model. So for example, if you have your Asia range, Asia more often than not consolidates. So therefore we know above and below the consolidation, there is liquidity, there is stop losses, and there's pending orders. And usually London is going to sweep the high or sweep the low of Asia. So if we now see Asia range liquidity, we have a supply zone above, and we have a bearish market, and then London opens, does a manipulation of Asia high, taps into the supply zone, and we get a lower time frame model to sell to Asia low. This is a very repeatable model. And there could be other ones. For example, you have Asia low taken, price goes up because it took the fuel of Asia low liquidity, price goes up into the supply zone, New York reversal. This is a very common model. If you start to peg daily cycle with time-based manipulation, with lower time frame confirmations, M1, M5, this is a very strong way to look at the market. But the information is not enough. We could speak more about this topic because it's a very detailed topic. But when you factor in these few confluences, then the next step is models, because I can teach people, hey, look at this liquidity, look at what this run of liquidity is, look at this time of day, and you can teach someone this, but they will never make profit, because now it's how you combine them. The biggest common mistake I see traders make is doing the right thing in the wrong way. They'll do the correct concepts, but they'll do it all wrong. For example, if you see, okay, Waqar told me I have to look for a run of liquidity, I have to look for a trend, and I have to look for London Open. So these are great things. And a lower time frame model, brilliant things. But what they'll do is they'll apply it in the wrong way. So they'll say, okay, Waqar said supply zone. So instead of looking at the correct supply zones, and I think the way to formulate a supply zone is a lower high that made a new low. It entered a new market territory and made a lower low. So that's a definition. Other people will say, okay, I see this 5-minute retracement and it made a low. It made an internal low, and they say, oh, that's the supply zone. So it's a wrong selection of a zone. So now they did the lower time frame confirmation, they did the London Open, and they look for the Asia sweep, but they picked the wrong supply zone. So now they did the right thing in the wrong way, and they'll take a loss. So when you give a strict criteria to all of these things, which there are many, I say run of liquidity. Okay, what's the difference between if I give you a consolidation range and the market goes here, it goes low? Is that a break of structure, or is that a run of liquidity? How do we define the difference? I will say break of structure, he will say run of liquidity. So I see break of structure, I'm going to sell. He's going to see run of liquidity, he's going to buy. But the price came here. So who is correct? Well, we need rules in place. So for this example of break of structure versus run of liquidity, they give opposite outcomes. The break of structure, look for sell. For run of liquidity, look for buy in a low, inducement low, or run of liquidity low. So you need to have definitions to identify between the two. So for this one, I'd say, okay, if it's a run of liquidity, what does that mean? If I've had a run of liquidity, it means stop losses have been taken and new orders have come into the market. So therefore, cause leads to an effect. So the effect has to be, if it's a real run of liquidity, I need to see bullish momentum. I need to see bullish candles. I need to see large imbalances. I need to see large candles. I need to see at a relevant time. I need to see bullish market structure internally. If I'm seeing all of these things with momentum and intent, this is signs this is a run of liquidity, because I saw the cause and then I saw the effect. If this was just a break of structure in a bearish market, so we had price come lower, price has now come into the inducement run of liquidity area, now we're having the retracement to then have a sell. This retracement portion, which is bullish, just like the inducement run of liquidity had a bullish reaction, but this one is going to be more compression. It's going to be more consolidative. It's going to take a lot more time. You're going to have no imbalances. You're going to have a lot of doji style candles. So it's going to look completely different, and it's going to be at the wrong time. So you can have qualification processes for everything. So that's what a trader needs to do. They need to take their concepts and then give exact criteria for it to be well-defined. And then the next step is you have well-defined concepts. Now you need to have well-defined trade models. So it can't just be, okay, I know these 10 things in my head and I've defined them well, perfect. And this is now like the last step before profitability, I think, is you have good concepts, you have good understanding. In backtesting, you're great, but in the live markets, you're not performing. Is because you think, okay, I'm going to use my run of liquidity, time window, market structure, and lower time frame confirmation. And I'm going to add in, what's another good one? I can add in momentum, because I want to see intention, and I add in a imbalance. This is a good one. These 6 things are brilliant, but now I can give you so many variations of all of them combined in a different way. So time can be fixed. We can say London Open, the first hour of London, perfect. That's a fixed one. There's no subjectivity. The market structure, you look for lower high and lower low. This can be quite objective, so we can put rules to this. But then there's other things, for example, a point of interest. I can see a point of interest on M15. You can see the same point of interest on H1. And then you can see it on M5. So we have the same zone more or less, but your definition is here, my definition is here, and his definition is here. So we have now discretion. These discretions will lead to the losses. So we need to have exact rules. We say, no, a supply zone is only valid if it leads to a lower low on M15. Okay, now we have a rule. And the supply zone needs to be at least 5 pips, but no more than 15 pips. Okay, we have a rule. The supply zone needs to have a manipulation inside M1. So when you investigate it on M1, we need to see a build-up of liquidity, a run of liquidity, and then price goes lower. And that lower has an imbalance. Okay, now we have another rule. So when we come to all of these supply zones, I can start to say, this one is not good, this one is not good, this one is perfect, this one is my supply zone. So now you build models and say, all of my confluences now have exact criteria to it. And now you need to build them in models. So you say, okay, if I have a inducement and I've categorized inducement as a run of liquidity. If I've categorized them, so I know I have a minor inducement. A minor inducement is I had a 1 minute time frame build up and I had a 1 minute run of liquidity. Perfect. That's a very small inducement. It's not the most significant. Then we can have an inducement of Asia range. Okay, this is better. We can have an inducement of a trend line and we run the liquidity. This is better. But then I could say, what about a daily structure point? Well, this is very strong inducement. So we have categories of inducements. So somebody will come and say, okay, we need time window and inducement. Perfect. But what type of inducement now? Because you might take the 1 minute time frame minor inducement and I might take the daily time frame structural inducement. My trade is going to be more reliable. So then you need to have categories. And then you start to build models around these categories and say, okay, this trade model 1 is supply zone in the way I just defined it, new lower low on M15 with lower time frame of manipulation inside and an imbalance. Okay, this is now my supply zone in this model. My trading window is only London open for this model. My lower time frame models are only these 3 types, internal break of structure, a 2-leg protocol, and a inducement break of structure. These 3 trade models only for this trade type. Then I need to see let's say leading into my supply zone, I need to see Asia high liquidity taken. Perfect. I need to see, as I tap into my supply zone, I need to see a little bit of consolidation first. Manipulate or build up of liquidity before my manipulation and lower time frame model. I've added in criterias. Once I've added in these criterias, now I have a mechanical system. And now I can start to test the system because I have exact rules, exact conditions, and I've put restrictions in. And now I can test it and say, okay, over 100 trades, when I follow these exact rules, what is the outcome? Okay, I know this trade model that just described, likelihood is going to have a 70% win rate. If you're following an M1 entry, you will have, with London volatility, a meaningful move on Euro USD or GBP USD. It's very common for London Open to move 20 pips. Very, very common. So if you can find a higher time frame supply zone, you find the manipulation and you trade the session volatility, 20 pips on the right direction is happening. It's very, very common. So now, why should your take profit be at 50 pips? When was the last time a London session did 50 pips? Once every 4 months. Okay, so I should not optimize for that. I should optimize for my session volatility. So then you add that as a criteria. So just like your entry criterias, you have exit criterias. You put everything into a model now with exact rules, and then you test the data. Then when you've tested this data, next model, next model, next model. If you have a trading system with 5 well-defined models with 5 data sets to it, then is how you track your performance. So if I'm starting a new evaluation today, a prop firm account, and I know I have my A+ setup, which is a high win rate, high risk reward, and I have my trade setup, which is counter trend, which is not so confirmed, which is trading maybe not with the time window. I know this trade model is good. It has a 50% win rate. It has a positive risk reward, but it's not an A+ setup. So if I'm starting a new account...
Let's just stop here. How
Yes.
do you evaluate the setup and the A grade of?
It's
It's based on the win ratio percentage that you got on backtesting, or is based on the number of confluence points that you have?
No,
on
it's
the
on
entry?
it's on the data. It's on the data. So you need. I said the sample size for any decision minimum 100 trades. So you need to test it. Whether that's 100 trades over 6 weeks or over 6 months or 6 years, you got to do 100 trades because that is the sample size where meaning can be found. This is from my uni days, by the way, when I was looking at scientific reports, studying literature in my dental career. There was in every scientific paper there is in the conclusion they always give, is this data relevant? And there is a score for this. So it's basically to say, is to take out coincidence. So for example, if I give you a certain headache pill and you feel better, but it was a sugar pill, it was placebo.
Yeah.
Okay, so that is a non-statistically relevant data point. So in trading, you need to have the same. And I think 100 trades, it mitigates any randomness, any coincidences. Okay, this was working because the market conditions were bearish right now and it was perfect for this type of trade, but long term maybe not. So 100 trade sample size, and then you test it all, and then you have data. Now, this is perfect for your psychology too, because psychology comes down to confidence, and confidence is simply a case of what I think will happen happens. And the more accurate you are in your I think this will happen and it does happen, the more confident you become. So confidence is not this mystery that people look for. It's a very simple thing. How can I increase my confidence? If I've seen this trade model play out 500 times in backtesting, I've taken this trade 30 times and it's profitable, then when I come tomorrow to the markets and I see the same thing, why am I going to be fear? Why am I going to be having all these emotions? I'll be confident because it's just another day in the office. I've seen this many times. People have psychology issues because they don't have confidence, because they don't have experience. But if you check off experience, you check off confidence, psychology usually falls into place if you have a correct plan. For this data curation, so we've built a strategy now, we've tested the strategy, now it's adhering to the strategy. So day to day, as you're tracking it, you'll start to realize there's differences every day. It's not always following your model. So then you need to have strict invalidation. So this is a step people forget, is invalidation criteria. So you'll say, okay, Waqar told me all these Asia range sweep, the time window, higher time frame supply zone defined as he said, and lower time frame confirmation. Perfect. But what invalidates that? So now you have the devil's advocate. So I can say a very strong invalidation is if I have my Asia range liquidity sweep into supply zone in London Open, and then I get a bearish reaction. Perfect. This is a confirmation. But then it takes Asia low liquidity and then comes back to my entry. No trade, because it should not take Asia low before my entry. Now we have an invalidation. So on the days that it doesn't take Asia low, I take the trade. On the days it sweeps Asia low, not my trade. I move on. Another invalidation is I found a M15 supply zone. Perfect. Now M5 is bullish leading into the supply zone. So I have my higher highs and higher lows on M5. Now let's say I have my last higher low that made the higher high on M5. I've now tapped into the M15 supply. So I'm now between two zones. If I have my lower time frame confirmation first, I enter. If I have my lower time frame confirmation forming and it hits the M5 demand, the higher low on M5, that's an invalidation, because now I don't know, is it bullish continuation or bearish reaction? So you have all these invalidations as well. So now you have entry criteria, you have exit criteria, and you have invalidation criteria. This is the devil's advocate. Because whenever someone takes a trade, a professional trader, they know that there's always reasons to go against them. A new trader will think, okay, I took a loss, but I learned a lesson. A loss is not a loss if you learn a lesson. A very common thing we hear. And I get it. It makes sense because you're still learning. But a loss for a professional trader is not like that. A loss for a professional trader is, I had these reasons for my trade. I was aware of these reasons against my trade. I made the decision to still take the trade as a calculated risk and as an educated guess, as a data-driven approach, despite the reasons against. And I know over 100 trades, 70% of the time I will be correct, but 30% or 20% of the time I will be wrong. Those
doesn't
reasons,
mean that you are wrong. It's just part of the statistic.
it's part of the data. We know it's part of the data. We tested it. We factored it in. And there's going to be certain times where the time window fails. There's going to be certain times where the supply zone was not correct. There's always going to be reasons against. And we should know that. We should not come to the market and think, oh, I took a loss. I have no idea why. Well, then you need to learn more. We should always know why we took the loss, and we are aware of the potential of the loss before we enter the trade. And then when we take the loss, we say, okay, we took the loss, and I can see why. And then when you are able to understand the market like that, then you're in a very strong position.
And then sorry to interrupt. It is very important to really understand this difference between being wrong and right and winning a position or losing it. You can do the right thing but still lose.
Yes.
It is really interesting the way that you are explaining how do you enter trades. Now I want to get in how do you manage the trade. You talk about invalidations and also confirmations of confluence once you are ready to take it. Now let's talk about once you're in. Two things. Even before taking the trade, what risk parameters you use in different setups, and also once you're in, how do you manage the trade? Is there also, while in the trade, invalidations that make you close the trade manually? All of your exits are automated by break-even or partials. How do you manage and how do you exit your trades?
Sure. So before I get into that, you said one important point, which was regarding a loss. That is, okay, we take a loss and we learn a lesson. When you're entering a trade, so for example, right now, I don't know if you're aware, I've been on my Twitter giving all of my trades ahead of time with not just a POI. I'm giving the exact entry, the exact stop loss, and I'm giving it before with my lower time frame confirmation and a full explanation, and then my break-even protocol, and then my take profit protocol. So I've been doing this for 6 months. All of my trades are there, and on Twitter, if you edit a tweet, it says edited, and you can see the time of the tweet. So I've said to everyone who's following me, some of my tweets are getting 100,000 views. So when you're getting that many views, one person should be able to say, hey, Waqar faked it. Waqar manipulated it. Waqar deleted a tweet. I haven't done anything. No one's been able to call anything wrong. 6 months, and in the 6 months, the reason I'm explaining this is because we can talk about data, or the data that I've done publicly. So in this 6 months, I gave 58 trades. At the time of recording. Out of these 58 trades, my win rate is about 65%. So I think that's reasonable. I also believe that win rate...
What average rate too?
So my risk reward ratio is fixed, and I'll explain in a second. So the analogy I always give on my podcast is, you know those guys in the circus that spin the plates? And the guy's job is to balance all of the plates, and that's the act. As traders, what we usually do is focus on one plate and we spin the win rate plate. So we say, okay, because it's a performance metric. And usually in life, when you go to school, the better your score in your exam, the better of a student you are. When you go to the gym, the more you can lift, the stronger you are, the better you are. And therefore, traders think the better your win rate, the better you are. And I think that's incorrect. That's focusing too much on one thing and it has an effect. For example, if I said to someone, you have to have an 80% win rate or I'm going to shoot you, they will do it. But how will they do it? They will be very selective. They'll be very, very high confluence trades and they'll be very patient. And you can have an 80% win rate, but that means you maybe take one trade per month. And, it's very restricted. So what happens? You can have a high win rate, but your trade frequency is low. And that's a problem because then your growth is slow. You have a high win rate, low trade frequency. You might make 10% in a year. But if you lower your win rate on purpose in a controlled way, the trade models I said, so you start off an account with your A+ setups because you don't want to start off with a losing streak. But now let's say you're on a prop firm account and you have 5% profit. You can afford now 5% extra risk. So you can introduce your A setups and your B setups and your maybe C setups. You can start to increase your trade frequency and lower your win rate in a controlled way. For me, my optimal win rate is between 45 and 55%. And I use that as a feedback loop. So for example, if over my last 20 trades, my average win rate has come to 70%, I know, okay, that's good. But now I can afford to have more trade types. So I will introduce my hedge trades. I'll introduce my counter trend trades. I'll introduce my re-entry trades. They're not a high win rate model. They're a low win rate model. But my overall win rate is a accumulation of my A+ setups that are 70%, my B setups which are 60%, my C setups which are 40%. But as a collective, it's within my range. So I know if my win rate is now getting a bit too high, I can add more B+ setups. If my average winner over the last 20 trades is getting too low, it's now 40%, 30%. Okay, relax, Waqar. Remove the counter trend, remove the hedges, stick to the A+ setups for a bit, and my average win rate will come up. So I keep it in this range. Why do I keep it in this range? Because I value trade frequency. I don't want to take a trade once a month because that affects my growth. So the plates we spin is your win rate plate, and I think 45 to 55% for an experienced trader is perfect. For a new trader, 65 to 75 because it's harder for them to absorb losses and stick to a plan. Your win rate should be there. Your trade frequency, I think, achievable, realistic, with the way I've explained. If you're trading intra-session on two currency pairs, which is fixed for me, EU and GU is all I trade. I think 3 to 5 trades per week. Between a London window and a New York window, between Euro USD and GBP USD, you have up to 4 valid opportunities per day. 3 to 5 trades per week is doable if you're using all of your models, A+ to B+ models. The other one is trade duration. I can take the same entry as you. You hold it as a swing trade, I hold it as a scalp. So trade duration is another consideration. People think, I need to be a swing trader because then I can get a really high risk reward. Okay, that's the idea. But if you take a entry with a 7 pip stop loss and you hold it for 2 weeks, you might have a crazy risk reward if it reaches target. But how many times will it go 20% to the target and reverse?
That's one interesting thing I want to ask you, because having a 45 or 50% win ratio with a large risk reward ratio.
Yeah, but it's also the higher risk reward becomes, meaning the further your final take profit is, the more doubt that there comes in. For example, if I can very accurately tell you where a London session is going to go. If I come to London Open, I can with confidence say it's either going to end low or higher. It's very easy to do that. But if I come to a Monday and I tell you in 2 months where the market is going to be, that's very hard. Not because I can't read market structure, not because of technical analysis. It's because in 2 months, so many things can change. So many roadmaps can present. So the further the timeline, the harder it becomes to accurately navigate the market. So for me, risk reward ratio is a vanity thing. It's like when businesses look at revenue, not profit. It's about return on investment. So risk reward, I've optimized. I can get a 1 to 50 risk reward trade. Can I do it often? Not really. Can I do it accurately? Not really. And I can do it, but how many times will I get close and fail? Yeah. So what's the point of having a trade that is 1 to 10 in profit and then it goes to break even? And this is a process I had, which was the next plate, which is account management. So a lot of people take their exits, manage their positions based on price action. I'm going to take profit when it makes a new lower low. I'm going to take profit when it takes liquidity. I'm going to take profit at this support level. Okay, these are all opinions and they change every day. And what happens when you have good knowledge of price action is, okay, Asia low could be a target, M15 structure target, daily structure target, this support level target, this trend line target. You can have 20 targets. Which one do you pick? Okay, and then you pick based on what you feel, on what you notice. These are all discretionary things. But I think the best approach for taking profit is data. And for me, the way I did it, just like I explained the Fibonacci, it's a bell curve. So if I know I'm optimizing for my London session, I know on average a London session is 20 pips. I know that after London session, New York session is average 20 pips. So the average daily volatility can be 40, 45 pips. So why should I hold a trade for 90 pips or 100 pips when I can just optimize a risk to reward where I have a 4 pip stop loss, 40 pip target? I can get a 1 to 10 in a session. And on my public signals, I have many times. If that's achievable, what's the point of holding it for the next day and maybe it reversing and I lose all my profit? No, so there's virtue in locking in profit. And what the consideration is, how many of my trades go to 1 to 3 and then reverse? How many of my trades go to 1 to 5 and then reverse? How many of my trades go to 2 pips in profit and then reverse? How many of my trades go straight to stop loss? How many of my trades go to 1 to 10 and beyond? You have to then measure this, because I can say, the best number is 1 to 5 because I feel like it. I can say the best place to take profit is Asia low because I feel like it. Your data will tell you what is the reality. For me, what I optimized and tested over 1,000 trades and over 2 years of testing, my optimal data was I take my first partial at 1 to 3 risk reward fixed. My stop loss is only between 3 and 7 pips. So if my stop loss is above 7 pips, I don't take the trade. If it's below 3 pips, I don't take the trade. So my stop loss is 3 to 7. So therefore, I know my 1 to 3 risk reward is between 1 to 3 between 9 pips and 21 pips. 9 to 21 pips is the average London volatility. So I know if I have an accurate direction for the session, I can very often hit my 1 to 3. The 1 to 10 target is my final profit. That's a little bit more challenging. It requires New York to continue in my direction. That doesn't happen every day. So going over the 6 months of trades I've taken and the 58 trades, what I've realized is that my stop losses happen about 25 to 35% of the time, but more often I hit break even because of my fast break even protocol. I break even very quickly because I'd rather miss an opportunity than take a loss. So when you have a good win rate, you have a very strict break even protocol, then it's a case of how often can you catch 10 to 15 pips. If you have the correct bias, you can very quickly. So over this 60% gain that I've done in the last 6 months, which is all there on tracked, and I threw on my FX book, I threw all the proof I could on my channel. In this 60 trades, out of the 58 trades of the 60% profit, about 40% of the profit is from my TP1, the 1 to 3. And therefore, the only remaining 20% profit is from my TP2, 1 to 10. So there's no sense for me to hold to 1 to 20, 1 to 30 and beyond, because my optimal window is the 1 to 3. So we could talk about all of these plates, but I think we're running low on time. But the idea being, I think traders should focus on their controlled variables, whereas traders focus on their uncontrolled variables. They can try and control the market. They try and control everything else. But what you can only control is your win rate, your risk-reward ratio, your trade frequency, your trade duration, your asset class selection.
Risk.
The risk per trade. Yes, this is a good one. And when you optimize each one of them for data, you build trade models for data, entry requirements for data, invalidation criteria. Usually, your psychology falls into place because you have a lot of experience, you have a lot of confidence, you have a lot of data. And then you just need to track your performance. And the last thing I want to say is when you take a loss, there's 2 types, a valid loss and an invalid loss. A valid loss is my win rate is 30%. Sorry, my win rate is 70%. 30% of the trades will be a loss. Is it one of those? Yes. Okay, nothing. No emotion, nothing. On to the next. I took this trade because I felt greedy. That's a invalid loss. So therefore you address that. And your goal as a professional trader now is sticking to your data, sticking to your plan and managing your invalid losses based on emotion and all these things. And then when you reach that stage, trading becomes very easy. It's a long journey. It's a hard journey. But when you reach there, scaling to $1 million net worth is very easy with prop firms. And I say it's the hardest way to make easy money. And that's trading.
Okay, so let's do the last question because we're running a little bit down on time. But I wish that we have more time because we can speak here for hours.
Yeah.
In terms of psychology and risk, because I think most of the psychology problems are directly linked to risk. It's normal then that if you're risking more than you can afford, or you are risking a substantial part of your account, even if you are Hulk, you cannot control your own psychology. But 90% of them, if you just use a strict risk protocol, it just wipes out 90%
Yeah.
of the psychology problems. So 3 questions in one. First of all, when do you break even? Because I wasn't clear about that. When do you usually break even? Second of all, what risk do you advise people, and also what do you use with own capital against a prop firm evaluation?
Sure.
And in this psychology topic, which is a very main topic in the industry, what are your thoughts on?
Just on the question on risk, I can speak an hour, so I'm going to keep it. I'm going
Yeah.
to keep it as brief as I can. Well, directly, the break even for me is always on the 1 minute time frame shift. So if I'm selling, the moment I have a 1 minute time frame break of structure, I break even. I will hit break even quite often, and that's okay for me because
But it's not a ratio.
it's a
thing.
frequency
It's not
thing.
a one-to-one ratio.
No,
but
it's not. It's not in a ratio. But I know, for example, if I get an accurate trade, I know my target one is 10 pips. With session volatility, it can happen, and when it doesn't happen, I hit break even. Better than a loss. So that's my approach. With regards to risk, there's people take a lot of losses and give up on the industry and fail because of risk, as you said, but it's because they fear an undesirable outcome.
Yeah.
And that is because I have my
haven't
rent to pay, I can't do it, fear. I need to make this money because my parents doubt me, fear. So when you're always chasing an outcome, you will always do wrong things, which is why I said right at the beginning, step one is having 10K in your bank account. The moment you have 10K in your bank account, you can pay your rent, you can pay for prop firms, you're not stressed. So whether you make a payout today or in 2 months, you're okay. That is the most liberating feeling as a trader because you're not chasing it. And 90% of traders that are failing right now in prop firms is because they're chasing the payout right now.
Yeah.
That is the biggest issue. It's not technicals, it's not psychology, it's that alone. So if you can solve that, you're in a better position. Now, when it comes to risk, there's 2 approaches. When you want to grow an account, there's the linear approach, which is just steady gains, and then there's the exponential growth. There's no right or wrong. But I think as a professional or as a more confident trader, year 5 and beyond, you should try and go for the exponential. Linear is great, and on prop firms and everything, you can make great money on linear growth. But when you have things very organized, data driven, and in a very experienced way, you will start to also think, how can I grow more and how can I make more? And I have this skill and it's very repeatable. I'm averaging this amount per month consistently. How can I make this more? This only happens when you've done that for a couple of years. So when you reach that stage, and I'm saying this because I've interviewed a lot of high level traders on my show that have done more than $10 million with verified proof. And they always say to me, which has put the thought in my head, Waqar, how are you going to grow? How did you go from this year 1 million? How are you going to go next year, in a few years 10 million? And my answer was, I'm going to keep going slowly. It was like, no, you can't do that because if you want to get to 10 million, it's going to take you 10 years or 20 years. You know, you need to work on things. So the 2 routes that prevail is you can increase your risk or you can increase your trade types. And for me, increasing my risk doesn't work for my mind. So if some people say, work 3 months, the first quarter of the year, to build a 10% buffer. And then month 2, instead of risking 0.5% per trade, risk 1% per trade. And then by quarter 4, the last quarter, if you're sitting on 20% profit, risk 2%, 3% per trade. So you're increasing your risk, but then as you increase your risk, your account should exponentially grow. Yeah. That's one approach, and I know a few traders that do that very well. But it requires balls. So I don't know if I could do that on large capital. The other way is, the way that I'm doing is, my risk is static. I will always risk the same amount no matter how confident I am. But what I'll do is I'll increase my trade frequency through trade models. So I will start off with A+ setups. But as I build my profits, instead of increasing risk, I increase riskier trades. So now instead of 1 trade per week, I do 3 trades per week and then 5 trades per week. And as you realize, if you're doing a good win rate on average with a good risk to reward, I don't need to increase my risk because I've increased riskier trades. So my rate of return per month can increase through the trade types. And with regards to your question on personal capital, I'd be very static with risk. And I usually don't, I introduce my A+ to B+, the C+ and beyond, I don't introduce onto my main accounts. But on prop firms, it's not my money. I have a reset button. So on that, you can be totally different approach. There's a couple of strategies that maybe on a part 2 we can discuss. I call it the revolving door accounts. It's a very strategic prop firm approach when you have like 5 accounts, because then you can manage positions in a specific way. And because you have the reset button and you can be risk free, you should be okay with taking risky trades because it's not your money. So there's a whole prop firm approach we can speak on for an hour. So I'll save it for another time.
Great. Waqar, honestly, it was a pleasure. I think a part 2 is obligated, is mandatory to do a part 2. So thank you for your time.
A pleasure.
Again, we could speak for hours, so we're going to leave that for the second part. Bueno, esperamos que les haya gustado. Sin duda, dejarnos en los comentarios las preguntas que les queréis hacer y además si queréis una segunda parte con Waqar. Ha sido un placer, se ha pasado el tiempo volando. Así que nada, espero que os haya gustado y nos vemos en el siguiente Orion Room. Un saludo.